that you keep talking, that is good. Otherwise, I will be really bored. No, actually, when you have to ask the question, the discussion goes to a different depth. Otherwise, it will be just a surface discussion. But the question that you ask, actually, sometimes certain things, actually, I realize the process and the operational part of it when you are asking some of those questions. Even this time, we also teaching, every time we also tend to think differently and learn something new. So that's good. Good that you keep asking questions. And it's not eating too much of a time as well. Certain things I'm planning to say later, you may be prompting that before. But anyway, it goes on well. No issue. Good. Shall we have that activity? So we will do it differently. So shall I? I can see Shahana, right? Others also, right. Now what we will do, shall I tell you, we'll go on for another 10 minutes because otherwise I don't know whether others are also there, and we'll give time for others also to come up, and then we'll have some sort of interaction. Okay. Right. So therefore we'll go with this, but definitely we will have that interaction before in another 10 minutes time after I take you through these quick things. Right? Okay. Can you see this worksheet now? We are back to this costing stuff. Can you see this?
Yes. Yes.
Right. So, right. Now, we were having this discussion on abnormal gain. Right? We were having this discussion with abnormal gain, abnormal loss. And this is where we were. Abnormal losses, no scrap value. Basically, what we said is, yes, when there's an abnormal loss, our overall turnover base comes down. But apart from that, our abnormal loss part of it, the margin is the same. But once you adjust it for the abnormal loss, our margin also comes down. That is obvious. Like if you have an abnormal loss, you can't be having final absolute profit. Also, the absolute profit margin will be definitely less. So that is what this is all about. Now, one more example here. Actually, two I want to do, but let's take this one quickly. Right? Now, do you see this worksheet?
Yeah, example 4 or 5?
Wait, it is
4.
Example 4 now. But I have numbered them wrongly. I have already done.
No, 4.
1 we completed, 2 normal losses, 3 abnormal losses. Yeah, it's 4. 4. This is it. Just try to understand the scenario first. What has happened here?
There's abnormal gain.
Right. Now, we had 12,000 units as input. 2,000 is the normal loss. Right. So, after 12,000 minus 2,000 normal loss, we expect to get 10,000 units, but we get 11,000 units. Right. So, there is an abnormal gain. Right. Because what happens is when you design the process, like I told you, due to the nature of the raw material, if it is concerned, if it is a natural material or extracted material, or due to certain process failures that can anyway happen, we keep a certain tolerance of wastage. But in certain instances, everything happens perfectly. No breakdowns, perfect power level, and good trained people, and the best quality material that you got. So then our output can be more than the normal rated output. So that is what has happened here. Our output actually after this 2,000 loss, we expect to get 10,000, but we have 11,000 units of output. Okay. Now, if you do this here, can you quickly do this cost per unit calculation? Can you quickly do the cost per unit calculation? What is the normal expected cost?
120,000.
120,000. And how much is the normal expected output? 12,000.
minus 2000.
minus 2000. So which means our cost per unit will be this divided by this 12 per unit. So now you see the point here is that whether you have a normal, abnormal gain or a abnormal loss or a normal loss, right? Now abnormalities will not change the standard cost per unit. We need to keep it stable, right? We are going to keep it stable. That is why we have it here. So that is this. And now can you quickly do the process account? I'll give you 3 minutes. Can you quickly prepare the process account? Okay. Input, direct material, what happens?
12,000 units.
12,000 units. And the value is
120,000.
120,000. That is done. Direct labor and overhead, that is done. Output components, what do we have?
Finished good.
11,000 units.
11,000.
Goods. We have 11,000 units. And the value of that will be how much?
132,000.
Into 12.
12. That is 132,000. That is what you have. Then what do you have?
No loss.
Abnormal gain.
Okay. First we take this.
Sorry.
Yeah, that's okay. We have normal loss.
2,000.
How many units?
2,000 units.
2,000 units.
2,000.
And what is the value?
0.
0.
0. That is 0. So which means this will be
2,000.
2,000 units and the value will be
0.
0. That is there. Okay. And then since this does not have value, we can close this account at the end of the period. That is there. And then when you try to balance this account, now what do you see? In terms of quantity?
There's excess of
Yes.
1,000
Excess
units.
And the-
of 1,000.
1,000. So therefore, obviously to balance it, that 1,000 should come into this side.
Yes.
Right? That 1,000 should come to that side, this side. So then that is an abnormal gain. Well, you can call it, okay, when it came on the credit side, it is abnormal loss. Now it is abnormal gain, obviously. Abnormal gain, that is clear, because whatever the value you transfer into the other side, it goes as a credit entry. So credit means revenue or an income. What is the value of that?
12,000.
Into 12.
Yeah, we have got an additional 12,000 worth of goods into 12. So 132,000. Now you will see this is also 12 plus 1,000, 13,000, 11 plus 2,000, 13,000. So the input and the output quantity is balanced. Value is also input and the output quantity is balanced. Okay. And then what happens is, now since there is value, everything when there's a debit takes place, there has to be a credit. So you debit it to this account and you transfer into the abnormal gain account from the
Yes.
process account. You will be transferring this 1,000 units and the value will be 12,000. So you'll be gaining 12,000 units. Okay. And what do we do with this 12,000 units? 12,000 value.
Added to
Take it to the P&L as
Yeah.
a gain.
And
Something abnormal, that entire 1,000, when you sell it, you transfer it to the P&L as a gain, 12,000. This is what is going to happen. Right? So then means that 12,000 will go earlier, the same 12,000 was a loss. Remember, when the abnormal loss, You credit here, debit to the income statement as a loss, but now you debit here and credit to the income statement as a gain. Okay. Now you prepare your income statement. What do you see? Just if you quickly prepare your income statement, what do you see?
It's going
Sales will be how much?
220,000.
Now it will be 12 into how much? 20 into
20 into 11.
11,000. Now we are selling 11,000. See, now there's an abnormal gain. We are selling 220. When there's an abnormal loss, we sell only 180. But when there is no abnormal loss, when there is no abnormal gain, no loss, so then straight away you will be selling 200,000. Standard scenario are 200,000. Our turnover drops if there's an abnormal loss, and turnover gains if there's an abnormal gain. But whatever it is, our margin without an abnormal or normal scenario is also standard margin is 40. When there's an abnormal gain, loss also standard margin 40, but the absolute profit comes down because the volume you are selling is less. When there's an abnormal gain, still your standard margin should be the same, but your profit will increase because there's a gain. So what is the cost of sales here? You're selling how many units?
11,000 into 12.
11,000 into
12.
130,000, which means this minus, you get 88,000. See, still 40% margin, but your gross profit has increased, right? And then abnormal, where will be a positive thing or a negative thing?
Positive.
positive.
Positive. Why? You debit into this account and you credit here. So therefore, it is plus 12,000. So which means now our profit is, is plus this 100,000. So now you see standard margin is the same, but the final margin after adjustment is now 45. Without the abnormal loss, it has dropped to, with the abnormal loss, it has dropped to 33%, but without any abnormal scenario, it is 40%. So without any abnormal gains or losses, 40. When there's an abnormal loss, it drops to 33%. But when there's an abnormal gain, it goes up to 45%, and this is 100,000. Yes, Rajiv.
If it doesn't take much time, because I lost Shamin's latter part of the discussion, he would have covered this probably. Just share the logic of deciding on the debit credit entry. If it is taking time, that's all
No,
right.
you mean to say this part here?
Yes. How do you decide a particular entry has to be a debit, credit, and so on?
No, it's like this. Now here, what happens is, now from the process account, we transfer process account. It naturally, now it starts from the process account. Abnormal gain. So your balance, say this is the forced entry. This is the naturally how the account was. But then forced entry is that you have to bring in 1,000 and 12,000 in order to balance this account, right? So everything else is coming from the double entries, right? This is something new that you have to bring in to balance this account. So now whenever you put a debit entry, there has to be an equivalent credit entry, right? So when you try to balance this account, there is 1,000, 12,000 difference. By this amount, the account is not balanced. So therefore, you have to debit this to this account in order to balance this.
Right.
But then you have to figure out which account you are going to credit it, right? So since there is an abnormal gain, you will be crediting it to the abnormal gain account. So that is why it goes as a credit to the abnormal gain account, depending on where it arises. In this case, this side was higher, this was lower. So therefore, our forced entry was this much. So forced entry came into the credit side. So therefore, you credit it here and you debit it to the abnormal loss account. So here, that is what it is. So therefore, depending on where we are going to bring in this, now all these entries, direct material, you credit cash account and you debit the direct material account. Direct labor, you credit the bank for cash account and you debit the whatever the labor account, and from that you bring into the work in progress account. So like that, always it is matched with the debit and credit entries, right? And then finally, now abnormal loss account, gain account, there is some balance. Now at the end of the period, either if you are going to carry forward like say a continuous period, you will be keeping that as a balance until the end of the year, or else you have to write it off in the period itself where it occurs. So here we assume that we are not going to carry it forward, we have to take it out and we have to clean it every end of every month. If that is the case, right? So you know that in order to clear this account 0, make it 0 balance. So then you have to have a credit entry here. And we are going to absorb into the income statement. So therefore, abnormal be credited here. So obviously, the naturally other entry will be onto the debit side. So therefore, you go and debit to the income statement. So always debit to the income statement will be either a loss or a expense. So therefore, it will reduce your profit. Debit to the income statement always reduce your profit. Credit to the income statement or always it will increase the profit. So here the natural balance is this. So you debit it here and you credit to the income statement. So which means credit to the income statement is either it has to be an income or it has to be a profit. So therefore, the profit will naturally be boosted up.
Okay, I got it. Thank you.
Okay, but later if you want, I can have another explanation depending on the time we have. Let me see whether I can explain it slightly differently as well. There's another slide which is there on this presentation. If possible, I try to show it before the end of the lecture. Okay, and one last thing on this particular area before we move on. I will just take this, right? It's a quick one. We can do it all together. This is no abnormal losses, no normal losses, nothing. But when there is a scrap value, like you told, whatever these damaged units, right? Whatever damaged units, you are not just going to throw away. Somebody is going to pay something and buy them, right? So it is inferior. If it is tea, not the proper quality tea, inferior quality tea, somebody is going to come and buy, right? If it is a plastic molding or whatever that thrown away, the damaged cartons or whatever packs, so you are going to take them away and give it to someone who is going to recycle it. Like that, or else if it is a food processing, you're not going to sell that as a main product, but you're going to sell that as a short life shelf life for animal feed or something like that when you sell it. So then that will be another thing. So there is some value for the normal loss. We call it like this, right? So before we do this, Rajiv, you had a question?
Sorry, Kapil, I didn't put the hand down. Sorry.
All right, okay, done. So now let's do this together, right? We can finish it in a couple of minutes. Now let's see what is the difference in this.
Scrap value.
Scrap as
Okay, everything is there, but for the scrap, we will have a $5 unit. Now, can you do the quickly? In a minute, can you do this calculation? Can you do this calculation in a minute?
Cost per unit is 10.
Okay, cost, let's do it together, right? Normal expected cost is 12,000. What is the normal expected output?
10,000.
10,000.
10,000.
10,000.
Okay, normal expected 10,000. But anything else? What is there anything that we have not considered here?
Scrap.
Okay, under normal circumstances, we know always there is going to be a 2,000 unit loss, and that 12,000 units anyway is going to give us a revenue of $5. Already this scrap element is there. So therefore, even though we incur $120,000 in this process, we will always be generating 2,000 into 5, 10,000 whatever the unit dollars of revenue we are anyway generating. It's a part of the normal process. Always when we run a batch, there will be a number of units that will not go as good units, but there's a guy who will buy it at $5 per unit. So therefore, as a natural part of the operation, what's going to happen is you will be generating anyway this into this. So therefore, under normal circumstances, our process cost is going to be only 110. So which means cost per unit is actually now divided by 10,000. It is actually only 11. Okay, so this is equivalent to normal loss equation. See, when there is a normal loss, without a scrap value, our cost per unit is 12. Okay, without a scrap value. That is what continues throughout here. But when there is a scrap value, that 12 will become only 11. Because you are going to get something. So I remove this, the normal gain. Yeah, this is what it is. So now our cost per unit has come down. Okay, because our effective raw material cost is less now. Okay, right. Now quickly, if we do the process account, what do we have here? 12,000 in this, and the value is 120,000. Okay. And what are the output components?
Finished goods of 10,000.
Finished goods, we are transferring 10,000 units. And what is the value?
110,000.
10,000 into 11, it is 110,000. Then what else do we have?
No. Normal loss.
Normal loss.
Normal loss. How much is the value? 2,000 units.
10,000.
So it will be
10,000.
into
5.
5. That is the difference, right? Now we'll see what happens. Now when you try to balance this account, debit side, the number of units is 12,000. And the credit side also number of units will be 12,000. This is done. And then the value, debit side is 120,000. Credit side is also, you will see this plus this, it is still 120,000. So this is balance. But however, this normal loss, what do we do with this normal loss?
Charge it to the normal loss account.
Yeah, we have to transfer it to the normal loss account. Okay, we can, I haven't drawn this account here, but let me see normal loss account. Normal loss account. What will happen is, from the process account, probably this value of this, it comes into a normal loss account, right? But however, this 2,000 units, we are not just going to throw away like this. It's going to generate us we will be keeping it there, right? But whenever we sell it, we will be getting an income. So therefore, whenever we sell it, what happens is we transfer it to what you call the scrap account, the same 2,000 units with a 10,000 value. So you transfer it here, 2,000 with 10,000 value. I just want to show you what happens, right? Don't take this entry seriously. So it's there in the scrap account, right? But what happens is at one point, we will be selling that. At one point, we will be selling this. When we sell it, what happens is we are getting money. So money comes into a bank account, which we say a debit, and we credit it to this account, scrap account. So we remove it from the credit account the moment we get the money, until this is something like a saleable, receivable, until we sell it. Because there's a person who is going to buy and pay us. So until then, since we can sell it and get it, we will park it in this account. So then once you do that, when we get the money, you credit here and you debit into your cash or bank account whenever we get the money. So therefore, there is nothing unbalanced here. And there is nothing unbalanced here. So everything is sorted out. There is nothing that you have to worry about, basically. Our income statement will have 20 into whatever the number of units, 10,000 units as this. Our cost of sales will be so much, but now you will see is our standard profit margin has improved. Why? Because there is a scrap value. Our effective raw material cost is less. So therefore, this our gross profit all this time has been 40 without a scrap value, say 40. But the moment there is a scrap value, what is going to happen is our profit is going to go up, not 40, 45%, not because our turnover is increasing, but because our gross profit, our cost of sales is actually effectively less. This is the comparable thing is this. See, this you can compare with without a scrap value. This is what we had. Say 200, 120. This is what we had. Say this is the what we had without a scrap value. This is what we had without a scrap value. So this is what you have with a scrap value. See, same 20 into 10,000 units, our sales value is the same. But here, since we are not having a scrap value, our cost is 11,000, 110,000. But earlier, without a scrap value, it was 120,000 more. So earlier, without a scrap value, our cost is high, margin is low. But here, same turnover, but the cost is lower because we are getting some scrap value and the margin is higher, and you end up with a higher profit because you're getting additional scrap revenue. So this is how it compares with the previous equivalent market. Okay, right. Again, you're not supposed to be double entry specialist, but quickly when you take through this, you see the logic. No scrap value, no losses, nothing. We are selling more and our margin is higher. But the moment there is a normal loss, so our loss, our turnover is also lost. Our profit is also less, and our margin obviously comes down, right? But when there is an abnormal loss on top of that, so then we don't even sell that much, but your standard margin doesn't change, but your final profit margin and the final profit is less because there is an abnormal loss. On the other hand, if there is an abnormal gain, our turnover is also more, but our margin doesn't change standard margin. But after adjustment of the abnormal scenario, our adjusted profit margin is higher, right? And then, of course, this is with the scrap value, our effective cost value of the amount of the cost comes down. So that is what happens when there is a scrap value, right? So those who are into banking and all the other industries, just get the basic essence of it. Again, I'm repeating, because those who are into manufacturing, it makes sense and you get value of this. Right, and then others, you had the basic idea, all these double entries, don't worry about it too much because this is enough. Yes, Rajiv.
Kapila, when you sell the scrap, isn't it the other income account that gets credited?
Yeah, actually the scrap account here is another income account.
Okay. Because here you mentioned...
This is not a main income account. Okay, sorry, no. Okay, Rajiv, yes, actually it depends. Sometimes, now, because it is two things. If it is a part of the standard process, you may not consider that as another income. If it is a part of the process, you may try to absorb that into your main raw material cost itself. Because if it is anyway, you let us say you put some material at the end of the process, there is some waste, and the next time you start the batch, say you put it back to the same raw material along with the normal ingredient. So it is something like that. As a part of the process, if it is continuing to happen, still there can be a practice to recognize as other income also. It may depend on the company, but there is a more frequent thing can be taking it into the normal cost itself. But let us say if it is something which is more than the normal loss, there is an additional unit that you sell, so then that can be definitely an additional income.
So how does this gets accounted in the P&L?
So here P&L, what happens is finally when you in your work in progress, your raw material cost itself, you will be reducing it. So it will not go to reach to the P&L level. See,
right?
It will not reach the P&L level.
Okay, now I understand.
Here
Right.
itself,
So your prime cost comes down. The prime cost comes down.
Yeah. If you don't do it at this point, so then you can consider that as a other income.
Yeah, right.
Got it? So there is nothing wrong in doing it that way either. Okay, right. So I think we will, at this moment, this particular part of the discussion, we will stop here. Now, like I told you, let's have some interaction, right? Because otherwise it gets really, this is the first time we had a class without physically meeting for such a long time. Like say we had about 7 lectures now. So what I think what we can do is, rather than just, I don't know, you also can suggest as we move forward, things that we can do. But for today, what I want to do is, I will put you into some groups, right? This is what I am thinking of doing. I will put you into some groups, about 4 groups. And what you can do is you can take about 10 minutes to discuss about each other, right? Anyway, you have to do group assignments and you have to benefit from the fact that there are so many diverse group of participants and get to know each other. All that is going to be good. So what you can do is you can have a chat among your group, maybe 10-minute chat. And then after that, what you need to do is say one person should introduce another person. Let us say Nalaka, Delma, and everybody, you all are in the same group, right? And then all of you get to know about each other, but Nalaka will introduce Delma and Delma will introduce Nalaka. Like that. So you'll introduce another person in your group. What do you think? Is that okay?
Yes, that's
Yeah,
fine.
fine.
And then also try to say something interesting about that person or unique about that person, right? And whatever that, if you want to add humor, whatever, all that is perfect. Okay, so shall I put you all into a groups then, and then when you introduce, all the team members should at least on the cameras, right, so that we can see. Right. Okay, give me a minute, right? I will just put you into groups. I don't see the breakup groups available. One moment.